policymakers. And we have a particular focus on discussing concrete policies that central banks and financial regulators could or should implement in this context. And today, it's my pleasure to welcome Glenn Rudebusch to present his and also his co-author latest research on market and the social cost of climate change. A few words of introduction. Glenn Rudebusch is a senior policy advisor and executive vice president at the Federal Reserve Bank of San Francisco. And in this role, he's conducting research and policy analysis on monetary policy, financial stability, and economic and financial development in general. But most importantly for us, he has recently written a few articles on climate change and economics. I would also like to note that Glenn is at the origin of a conference on economic and climate change that the San Francisco Fed organized 1 year ago in November 2019. It seems a very long time since that happened. And to my knowledge, this conference was the first time that an institution in the US Federal Reserve System took a closer look at climate change and the implication of climate change for central banks and financial supervisors. So on a personal note, I would like to praise him for this initiative, which is very important in the current context. Glenn is also the organizer of a very interesting virtual seminar on climate economics, where academics present their latest research, and I can only recommend you attending this virtual seminar. I think it completes our seminar as well, and I would say that our e-axis seminar is a bit more focused on policy than research normally, but both seminars give a complete overview of the current landscape regarding research and policy making on climate change and monetary or financial policies. So before giving the floor to Glenn, just let me remind you that parallel to this webinar series, e-Access is also curating a platform that is open to you to exchange ideas and information on climate change, macroeconomic and finance. So I can only recommend you to go to the e-Access forum webpage to access this platform. And you can, I'd say, either ask your question in the chat box where I will then relay to Glenn, or I think there is also a Q&A box where you can post question and then please raise your hand virtually so I can give you the floor to ask your question directly. So it's not time for me to let Glenn speak about his research on the evidence of rising climate costs that he finds on bond markets. And yeah, we all looking forward to get your insight. The floor is yours, Glenn.
Thank you, Pierre. Thank you for organizing this. Thank e-Access for hosting it and organizing it as well. I think this is a great seminar series, a great initiative. As you mentioned, we're doing something parallel, complementary, the virtual seminar on climate economics, which you can find on the Federal Reserve Bank of San Francisco website. But, you know, this is such a big area. There's so many questions to be asked and hopefully answered that having two seminar series really is not enough anyway. So thanks again for organizing this. Let me share my screen here. How does that look, Pierre?
It's fine. At least I can see it.
Okay.
Perfectly.
All right, good. Excellent. So this is titled The Rising Cost of Climate Change, Evidence from the Bond Market. It's joint work with Michael Bauer, who's at the University of Hamburg now, and he's on the line, so he can answer any hard questions. Feel free to ask away. Let me just hide this information here if I can. Oh, well. To start off with, I thought I'd start with some basics just to put this in context. Climate change is intergenerational externality. So that's how economists think of it. So we've got these carbon emissions, carbon pollution. The carbon emissions accumulate, carbon dioxide concentration increases, and that causes long-lasting climate damages. We've got higher temperatures, more extreme weather, sea level rise, ocean acidification, all sorts of issues and damages from these carbon emissions. Economists would, of course, consider a cost-benefit analysis in thinking about it. That is, we're going to compare the near-term costs of climate change mitigation against the present value of reduced damages for future generations. So, for example, I've got a little graph here. This is time. There are the near-term costs of climate change mitigation. So, for example, we've got to spend money in order to build solar panels, decarbonize the economy. And then there are going to be long-term benefits from reduced climate change damages. So how do we compare these two costs and benefits? We can't do it just in terms of the size, but we have to consider these, we have to discount these into present value to be able to properly compare those near-term costs and future benefits. Assessing climate change, then the discount rate is crucial, and for these public questions, public policy questions, we use the social discount rate. And the level of the social discount rate is crucial for evaluating long-lasting climate damages. Here's a little example. The present value of $1 billion of damages 100 years from now equals $138 million now with a 2% discount rate, and 4 times more, $607 million with a 0.5% discount rate. That is the discount rate because of the compounding. Small changes in the discount rate over long horizons can have very large effects. That's the level of the social discount rate, the SDR. There's also a term structure of SDRs. So for each horizon, the SDR should match that horizon. SDR should match the horizon at which various costs and benefits are realized. That is, you wouldn't apply a 2% or a 0.5% discount rate for all future horizons, for all future benefits over time. Instead, you need this term structure, much like a term structure of bond yields at different maturities. You need a term structure of social discount rates for these different horizons. So this paper is going to be all about the level and the term structure of SDRs. There's, of course, a vast literature on intergenerational social discounting and climate change. Here's reviews by Ken Arrow and Gaulier. But despite that, much disagreement remains about the appropriate level and term structure of SDRs for evaluating climate change damages and for calculating the social cost of carbon. And I'll talk more about that. And that's really what this paper is trying to make some progress on. There are 2 basic approaches in the literature to social discounting. One, one's been called a prescriptive approach. That is, what level of the SDR is optimal or fair or acceptable. And this is usually based on social welfare theory, the Ramsey rule, normative judgments. An example is the Stern Review. In 2007, used a normative social discount rate of about 1.4%. And the kind of judgments that go into that are, for example, well, how should we think about future generations' welfare relative to our own? How should we compare those? That comparison is usually, future generations, we shouldn't discount their welfare relative to our welfare. But of course, they're going to be richer, presumably, than we are. So that can be taken into account. So these issues can be used sort of as a theoretical, prescriptive, normative way of thinking about the SDR. We're going to be taking a descriptive approach. That is, what are the observed real returns in financial markets? This is the approach used by Nordhaus, for example, 2007. His view is that you've got to look carefully at the real interest rate, and that philosophical reflections are largely irrelevant. So there's this split again between this descriptive approach and the prescriptive approach, and a lot of a fair share of researchers find that thinking about observed real returns in financial markets is a better procedure. Financial market valuations embed preferences about intertemporal trade-offs. So they embed the preferences of society, or at least the investors, about intertemporal trade-offs. And an example is Nordhaus 2013 uses a real rate of 4%. So we've got this difference between 4% and 1.4%. This is prescriptive, normative. This is a descriptive or positive. And that's generally true. Descriptive SDRs tend to be significantly higher than prescriptive social discount rates. Maurice Drup did a survey of experts and queried them on their positive, their prescriptive and descriptive SDRs. And he found that descriptive SDRs tend to be 2 percentage points higher in this survey than prescriptive SDRs. And we're going to make some progress in narrowing this difference, I think. So what is this paper about? In this paper, we're providing an up-to-date descriptive approach to SDRs. We show conceptually that the equilibrium or steady state real interest rate, R star, anchors the term structure of discount rates. So one of the reasons, let me mention again the seminars, this seminar and our own seminar at the San Francisco Fed. I think one of the impetus behind those is to try to bring climate economics to a broader set of researchers and a broader set of people, thinking that climate economics is not just something that should be, say, in environmental economic conferences, but really is more interdisciplinary, that it's too important a topic, it has too many different facets, it's going to touch every sector, every aspect of our lives. And so in this paper, we're really bringing a macro finance approach to thinking about climate. One of the important concepts in macro finance of the last decade or two has been this R star concept. That is, it's this equilibrium or steady state real interest rate. If you think about where the short-term real interest rate is going to be in 20 or 50 or 100 years, that level is what R star. It anchors the term structure of discount rates. So the value of this paper is to bring this macro finance perspective to thinking about a descriptive approach to the social discount rate. And R star is going to be a crucial part of that. So part of our paper is this conceptualization about how R star, this equilibrium real interest rate, is going to be important for thinking about the level of the social discount rate. We're also going to do some empirical work in a couple of stages. We incorporate R star into an empirical time series model for the risk-free social discount rates. So we're going to estimate some empirical time series models of real rates, and then actually provide estimates of R star. We estimate a 1 to 2 percentage point decline in R star in the equilibrium rate in recent decades, and that's consistent with a macro finance literature by Thomas Laubach and John Williams, and work by myself with Jens Christensen and Michael Bauer, most recently published earlier this year in the American Economic Review. So again, there's this large macro finance literature, but it's on R star, but that's generally has not been incorporated into thinking about the climate economics or the approach. After getting these empirical estimates of R star and this empirical model, this empirical time series model for R star, we're going to then calculate what this lower new normal for real interest rates implies for social discount, for the term structure of social discount rates. So we're going to be interested in how the level of social discount rates moves and how the term structure of the social discount rates move. And we're going to infer unobserved long-run social discount rates from models of historical risk-free rates. So again, we don't have bond maturities of 100 years, but we can create an empirical model of the term structure of short real rates, and then calculate what that term structure looks like. In terms of our results, we estimate that the lower social discount rates at least double the social cost of carbon. So a reduction in R star has really profound implications for climate economics. And our new, as I mentioned earlier, our new descriptive SDRs align well with previous low normative SDRs. So that's kind of an overview, a summary of the paper. And let me talk how this connects to the other literature. As I mentioned, there's a large related literature on discounting climate change. This approach, this general approach, is called an econometric expected net present value. At least that's the terminology of Freeman and Groom, where, again, we're estimating a stochastic process generating future interest rates from historical data. Under the assumption of risk neutrality, that is the expectations hypothesis, long-term SDRs equal average expected future short-term SDRs. So that's the general approach that others have taken, that we are also using. However, earlier implementations of this approach assumed a constant long-run R star. So these are some of the papers, Newell and Pizer, Groom, Gaulier. They all assume that R star is constant, and that short-term interest rates are stationary. And again, that goes against sort of where macro finance, the macro finance evidence of the past couple of decades. So again, we're bringing this macro finance perspective, this macro finance evidence that allows for a long-run trend or shifting endpoint in real interest rates, instead of imposing that stationarity. So this time variation in R star, time variation in the equilibrium real interest rate, provides different results than if you assume a mean reversion to a fixed long-run mean. I've got a few slides now to sort of set the background or the groundwork for our analysis. Just to make sure we understand, I think it's important to know I mentioned risk-free rates and how risk and risk-free rates are going to interact, and also sort of how the bond market fits in. So let me talk about risk a little bit. So discounting depends on the risk characteristics of future payoffs. In the standard asset pricing framework, discounting depends on time, of course, we've talked about that, but discounting also depends on risk. So discounting depends on the correlation of payoffs with aggregate consumption growth, the so-called consumption beta. I'm sure many of you have heard about stock market equity betas, and how individual stocks may be correlated with the market as a whole, and that's a stock market beta. But here is a more general way to view this is as a consumption beta. And so there are two ways to think about how consumption damages, what the beta may be, and how consumption damages may be connected to growth. One is if growth tends to occur, if climate damages tend to occur when growth is strong, that's a positive beta. In that case, mitigation projects are riskier or of less value for society. So the social discount rate is higher than the risk-free rate. So again, if growth going forward is very strong, we have a lot of emissions, there's a lot of damages, but we're richer as well, then in that state of nature, we can, the economy, society is able to handle the damages better, and we don't have to be as worried. We can discount those future damages a bit more. Alternatively, if climate damages coincide with a poor economy, that is beta is less than 0, then mitigation provides insurance or hedging benefits for future aggregate risks. So the SDR is less than the risk-free rate, and we worry more about those future damages. So mitigation projects with different risk characteristics require different SDR. Unfortunately, the risk characteristics of climate change projects are generally unknown or certainly understudied. So this is a way to think about risk, which is a crucial part of, I think, climate economics, should be a crucial part of climate economics and climate finance. It's a crucial part of the problem. So how do we go from risky projects to using risk-free rates? So thinking about using the risk-free social discount rates to discount risky payoffs. So asset pricing can disentangle this time discounting and risk discounting. First, we transform risky payoffs into certainty equivalent or risk-adjusted versions. So we've got the risky payoffs here, x sub t plus n. We're going to transform them into thinking about, well, what would a risk adjusted or certainty equivalent version by adjusting their systematic risk. So if we have that positive consumption beta, the risk adjustment lowers the certainty equivalent payoff. If we have a negative consumption beta, it raises the certainty equivalent payoff. So rather than changing the discount rates for these different projects, we're going to change the payoffs, transform the payoffs, and that allows us to use risk-free rates. Alternatively, even stochastic payoffs can be riskless if they are uncorrelated with the future real stochastic discount rate, that is future interest rates and marginal utility. So once we have these discounted risk-adjusted payoffs, then we can use risk-free discount rates estimated from the rates of returns on risk-free assets to calculate them. So here we've got the present value of the payoffs depending on the certainty equivalent discount rates, and here we've got the risk-adjusted payoffs. So we are going to be estimating the term structure of risk-free social discount rates, that is the y t for maturity n here, and that's going to be suitable for discounting certain or certainty equivalent future payoffs. One last issue is which empirical market-based rate of return to use. So we're going to use real government bond yields as the source for determining the descriptive risk-free social discount rates. And that's why the paper is the evidence from the bond market. The bond market, bond yields, government bond yields give us that risk-free, will give us that risk-free social discount rate. I think it's particularly appropriate from the perspective of financing public policy actions, because there it is the inflation-adjusted government bond rate that is the appropriate cost of capital for climate change mitigation projects and intertemporal trade-offs. However, government bond yields, as I mentioned, rarely extend past 30 years, so we're going to derive the long maturity social discount rates from econometric interest rate models fit to the yield data. Alternatively, some have used estimates of economy-wide rate of return on productive capital, say from equity markets, as a measure. However, greater risk premia, market power, unmeasured intangibles have widened the divergence between the rate of return that savers earn and the private rate of return to capital. We think it's the government bond yields that are the more relevant rate of return and the better measured rate of return for calculating the social discount rate. All right, let me now talk a little bit more about R star and the R star anchor for the term structure of social discount rates. We can define R star as this equilibrium or long run level of the real short rate, RT. So R star T equals the limit as the horizon goes to infinity of this expected value at time t of that future short rate. R star determines the level of the term structure of real discount rates. As I mentioned here, we've got the this discount rate at time t at horizon n. That just equals the average of future short rates plus a convexity term that reflects uncertainty. So this is essentially the expectations hypothesis plus the convexity term for uncertainty. We can decompose that into R star T. Then there's a cyclical component of the short rate. So this R tilde equals the short rate minus just deviations, just sort of current deviations from the long run equilibrium real rate. That's a cyclical component of the short rate. So we've got R star T, we've got the average cyclical deviation from R star, and then again, this convexity term. Why did I put this equation up? Well, the point is that you can see that whatever the maturity of YT, they all depend one for one on R star. So all social discount rates move one for one with R star T. That's, I think, an important part. Two other factors are going to be that short run SDRs are affected by current rates. These cyclical deviations are sort of a shorter run phenomenon. That's going to be important for thinking about shorter run discount rates. And then longer run discount rates are going to be lowered by convexity. And Marty Weitzman has talked about this. We call this a Weitzman effect. So that's our basic framework for how R star, conceptual framework for how R star anchors the term structure of social discount rates. So R star has been estimated quite a bit in the literature. Here's a range of estimates from the literature. And so we've got various papers, Del Negro, Johansson, Laubach, Kiley, some work I've done with Jens Christensen. These are estimates of R star. These are decadal averages. So you can see for the decade of the 1990s, these are the estimates from the literature. This is our own model, the UC model, the 1 year rate. I'll talk more about that in a minute. I'll describe that in a minute. This is their estimate in the 2010s. This is the change between the two decades. So if we look at a mean You know, in the 1990s, R star was, these estimates were averaging around 2%. In the 2010s, they were averaging around 0.75%. So we've had this 1.25 percentage point decline in R star over the last couple of decades. Where do our estimates come from? So we're going to estimate an unobserved components model that allows for shifts in R star. A simple model, this is just a decomposition of the short-term real interest rate into the equilibrium rate and the cyclical component, as I mentioned. The equilibrium rate is a random walk process, and the cyclical component is a stationary one. So we can decompose all the changes in R star into shifts in, all the changes in RT into shifts in R star or fluctuations in R tilde. We're going to use annual data for the real interest rate, the differences between the treasury yield and survey expectations of inflation. We conduct a Bayesian estimation with a tight prior in order to avoid overly volatile R star. Our prior, our macro finance prior on R star is that it doesn't move a lot period by period, but instead responds to some of the slower trends in the economy. So demographic trends, for example, more saving, shifts in the population of older versus younger might lead to shifts in saving. And there are a variety of shifts in terms of how much capital the economy needs to produce output, the price of capital. Those kind of changes can lead to gradual shift in R star. So our model provides new estimates of R star and of the term structure of risk-free social discount rates based on this time series model of real interest rates. This is what our estimates look like. So these estimates of R star, this solid, the black line is the actual data on the short real rate, and the blue line is our estimate of R star. And you can see that it was quite stable through about 1990, and then has declined from about 2% to just under 1%. And again, that's the kind of estimates we were talking about in the literature. It's consistent with the macro finance literature, a drop of about 1.25 percentage points. We consider a variety of different models, different permutations on this model for robustness. We've got an unobserved component model with the 10-year real rate, the nominal yield minus a longer run inflation expectations. We have state space models that have two trends, one for pi star, one for R star, using data on the nominal rate and inflation. And then we also consider an alternative model without a random walk. That is, rather than, some people get hung up on random walks in finance, we're going to consider a mean shifting AR1. So if you just thought, well, I don't know if this is a random walk, this real interest rate data, but certainly if you fit a AR1, you can get a significant break in the mean. So the mean might be 2% there, and then under 1% after 2000. That's another model we're gonna consider. So we have a shift in this mean at 1995. The optimal choice of tau of when this shift occurs is similar. It's close to 1995. So here are our estimates. The unobserved component model, this is sort of our benchmark model, the 1-year rate. We've got an estimate in 1990. So here we'll talk about not decade averages, but actually in these years. In 1990, the estimate was 1.8%. In 2019, it was 0.6%. So we've got this 1.2 percentage point change. And then these other models are for robustness. You can see sort of ranging from 1% to over 2%, from 1 percentage point to over 2 percentage points change in R star. So our benchmark is going to be certainly consistent with these other models and consistent with the earlier literature. So how do we calculate the implied term structure of SDRs? We're going to calculate this model implied term structure at two dates, 1990 and 2019, using these two. These are the two dates we'll be using, and we're going to quantify the shift in social discount rates. We assume risk neutrality to obtain a term structure of short rates. We've got this model for short rates, so we can use the point estimates of the parameters and the time t state variables, and then simulate that model out 100,000 times, and then calculate this term structure of SDRs based on this the expected average short rate across these simulations. We are going to use a shadow rate specification to rule out negative social discount rates, and that's done here. So this is a graph of the shift in the term structure of social discount rates. Again, from the benchmark unobserved components model for the 1-year rate. These are the discount rates, YTN, across maturities N. So this is horizon or N maturities. As I mentioned, R star in 1990 in this model was 1.8. R star in 2019 was 0.6. And these are the associated, the red line, the solid red line, and the solid blue line are the two term structures of social discount rates that are implied by our model with a shifting equilibrium real rate. Let's now talk about the implications of this for the social cost of carbon. The social cost of carbon is just the present value of future damages, denoted here by MD, marginal damages, from one additional ton of CO2. So this is the social cost of carbon for a ton of carbon dioxide, or the social cost of carbon dioxide. The social cost of carbon then is that additional ton evaluating on those marginal damages, but discounting them with the social discount rate. And that's the crucial part. So two ingredients are required. One is a term structure of discount rates, and that's these YT. And there we're going to use the model-based term structures from 1990 and 2019 to assess how a lower R star, a shift lower in R star, affects the social discount rate. So again, we're going to use these two, the red line and the blue line, as these term structures of discount rates. And then we need estimates of future marginal damages. And here we're going to just take these from the literature, and we're going to use estimates from integrated assessment models, or IMs. The DICE model is going to be our baseline for providing estimates of future marginal damages. This puts us in the same literature as, similar, comparable to Newell and Pizer and others who also use this DICE model. We're going to use, and they use the DICE, the 1994 version of DICE. That makes it quite easy then to compare to these earlier results. And we're going to be looking at marginal damages over the next 400 years. As robustness checks, we also look at a more recent vintage of the DICE model, DICE 2016. And we also look at an improved version of the DICE model by Simon Dietz and others. I should note that the DICE model is deterministic, so in principle, risk-free real interest rates are appropriate for discounting. So the lower estimates of the social cost of carbon are obvious. The lower discount rate gives you a higher estimate of the social cost of carbon. So our lower estimates of social discount rates boost the social cost of carbon. Here we've got, again, our 5 models. let me focus on this top line, which is our benchmark case. So these are estimates of the social cost of carbon using the DICE 94 damages and our two-term structure of social discount rates. This just reminds you of what the change in R star is over between these 2 years, a decline of 1.2 percentage points. This is the social cost of carbon calculated in 1990, $31.80. This is the social cost of carbon calculated in 2019, $68.70. We use the same marginal damages to calculate these two social cost of carbons. The only difference is that we're using a different term structure of social discount rates to evaluate those future damages. And you can see the drop in R star led to an approximate doubling of the social cost of carbon. The other models give similar results, perhaps larger or smaller, depending on the change in R star that's estimated. Let me conclude then. The point of this, I think the underlying point of this paper is that macro finance shifts, or more broadly, macroeconomics and finance, are important for thinking about the economics of climate change. So there should be, again, much more of this interdisciplinary approach to thinking, to research in climate research. For our particular results, the secular decline in R star lowers all discount rates and substantially boosts the social cost of carbon. As I mentioned, social discount rates from a descriptive approach, that is these market rates, in the past were significantly higher than from a prescriptive approach, that is the normative judgment. Our results bring both approaches into closer alignment and close to where the normative social discount rates were in the past. In terms of future research, let me mention that we've only sort of taken these lower equilibrium interest rates. We've estimated them based on sort of the change in the equilibrium the change in R star, say, that occurred over the past couple decades. Going forward, R star may change further. The demographic changes that seem to be responsible for R star, their decline in R star, appear to be very permanent, long-lasting. However, future climate change may also lower equilibrium interest rates further, and a deeper understanding of this issue requires a joint modeling of macro finance trends, the economy, and the climate system. So that's a way to think about broadening the IMs or deepening the IMs to allow for not just changes in the economy, but really changes in how climate is interacting with longer run trends. Pierre, let me stop there. I'm happy to take any questions.
Yeah, thank you very much, Glenn. So Michael has been busy answering the questions that were asked already. So
okay.
A few of them are covered, the most technical one, I would say. I mean, everybody, you can type your question in the QA or in the chat, and I will try to relay them. In the meantime, one remark and one question. So first, I really like the neat treatment, financial economics treatment of your paper. It's good to see proper finance reconcile with proper macroeconomics. And one of the conclusions that you have is, to show that a small change in the discount factor can yield to totally different estimation for the social cost of carbon. And in that sense, to take a more applied perspective, what does it change in your work at the central banks to have like suddenly the cost of carbon, social cost of carbon double the estimation? I mean, how do you integrate that in policy making at central banks? Does it have any concrete impact on how do you integrate that in your analysis for setting monetary policy in general? If you could.
Yeah, so I think that, central banks, we were talking earlier, central banks are still at an early stage in thinking about how to integrate climate change issues, climate risk into policy considerations. Certainly the social cost of carbon is a crucial, I think someone called it the most important number you've never heard of before, and it's a crucial issue, primarily for fiscal authorities at this point. That's where a lot of the policy has centered around what is the social cost of carbon, and that's an important issue. I think for monetary policy or for central banking, climate change has primarily been an issue that has been integrated in terms of climate risk and financial stability. And there, the analysis is not so much on the social cost of carbon, but an issue of how to think about the physical risks of climate change going forward and how they're going to impact financial markets. It gets a bit to that interaction that I mentioned of financial markets and climate change and this longer run. If climate change were to affect our star, that would be relevant for, if we're in even a lower new normal for interest rates, that's going to be relevant for monetary policy. But I think we're still some ways from making that to bringing that into the policy process. So I would say the social cost of carbon, taking this in a very linear fashion, the social cost of carbon is most obviously relevant for fiscal actions. But I think a deeper understanding of the connections between these trends and climate change is one avenue for which they would be relevant for monetary policymakers.
Thank you. I have two similar questions from Emanuele Campiglio and Ulf Erlandsson, so I'm going to allow myself to ask them directly to you. It's about the shape of the social discount rate term structure that you find. So do you have any explanation for the change in the shape? And what is the interpretation of shifting the shape of the SDR curve from inverted in previous research to this new steep flat inverted shape? So basically about the consequence of the new shape that you find.
Happy to take this one? Or?
Oh, sure. Go ahead, Michael.
Yeah, so do you want to show them, Glenn? Sorry, I didn't mean to cut you off there.
This one?
Yeah, exactly. The comment is, point well taken. It's declining, in a monotonous fashion before, and now it's kind of hump shape. Yeah, I mean, this is still consistent with the, general truth that, long run discount rates are going to be declining because of this, famous Weitzman effect. Weitzman, Gaulier have written both a lot about this, that discount rates are ultimately declining. And that is still true, even with the very much lower R star, the lower level. There's just this, hump shape at the short end, which is just driven by the current value of the real rate. In 1990, the real rate was over 3%. In 2019, the real rate, the proxy for the real rate that we're using here was about 0, or even just around zero. And so that's what drives the short end of the term structure. But yeah, that's why you see the hump shape, but this is not at odds with the, kind of, if you go out from the very, from short term, from short maturities, then you'll see this decline. And there's a little bit of a different slope, which is just due to the fact that, how close you are to the zero lower bound, which we're imposing here on real rates. And so then you have a little bit more or less, kind of convexity effects depending on how close you're to the zero lower bound.
Thank you. So if you want to ask a question, please use the participant box and raise your hand.
There was one question that was kind of really neat, maybe worth going back to, Pierre.
Sure, please.
This, Rubin Döttling said that for the descriptive approach, is it a problem that future generations cannot trade in financial markets and therefore determine prices today? So that's kind of the fundamental question. With this descriptive approach, how is this justified in terms of trying to infer preferences over current and future generations, or preferences over consumption today and consumption of future generations? So I think that's it's kind of a, complex question. I was just writing here my answer in the Q&A that, in principle, the assumption of the descriptive approach is that financial market rates do reflect these preferences correctly. But, there's, of course, the possibility that, in some sense, it's only how we see, how we value that. And the future generations don't really have a say in this because they're not born yet and they're not trading these markets yet. So. But this is kind of a fundamental question about the descriptive approach. But we're following kind of a long tradition here of descriptive analysis of social discount rates. And the key is really just one of the main points is that we only observe the rates up to maybe 10 years, 30 years, or maybe 100 years. Rick van der Pluk mentioned the work by Giglio and Strobel and Maggiore that gets very long run rates, but still nowhere do you observe rates that we need for discounting climate change, 200, 300, 400 years of damages. And so that's why an approach like ours can be helpful to infer these unobserved long run rates.
Let me also go back to Emmanuel Campinolo's question about the, explanation for the change in the shape. And I think we were focused, maybe Michael was focused mainly on the hump shape, but I think there's also, perhaps the question is also the crucial issue is this drop in the level of R star. I didn't talk much about that. There is a literature, the R star literature, talks about the underlying economic forces that are driving the decline in R star. These include lower productivity growth, the changing demographics that I mentioned, the decline in the price of capital goods, strong precautionary saving flows from emerging market economies. And these all tend to increase global saving and reduce desired investment, and then they have that downward pressure on the equilibrium on real interest rates, the equilibrium real interest rates. So that's kind of the fundamental economics behind what's going on here. The evidence is that over long samples, it's the fraction of the total population of working age, the average life expectancy. Those are reliable drivers of the equilibrium real interest rate.
Michael, you want to add to that?
No, that's really important. One point is that these are all kind of very long run structural changes, and so in our modeling approach and all the papers that Glenn has mentioned, these are assumed to be permanent, and Now the question is, and that was kind of touched upon in the conclusion slide, you know, how is this going to evolve going forward? You know, some people think that R-star may fall some more. And some demographic forces kind of make you anticipate that. And then also, you know, if climate change slows down our future growth, you know, then, you know, that could work in that same direction. But that's something, you know, that we don't address here. What's this, you know, where is this going to go in the future? But you know, there's certainly downside risk to shift this dashed blue line and that whole term structure down even further. So that's a real concern.
One question that I would have, I mean, Glenn, you mentioned that for central banks, climate change is very important from the financial stability point of view. That the angle they kind of all take now to look at climate change and to see the consequence for the policies. What does your kind of results, basically a change, like a revision upward of a social cost of carbon, imply for financial stability? I mean, when such results are published and are integrated by market, does that represent a risk for financial stability, or how is the consequence on financial stability, you think?
Again, I don't think shifts in R-star have, and the social cost of carbon in particular, because again, that's a public policy issue, while financial stability from a microprudential standpoint sort of works on the profitability and the viability of financial institutions more generally. So they probably have their own internal rates of return and their own thinking about that discounting, and that's where it should come in. Not so much the social cost of carbon, because these individual financial institutions, these individual actors probably aren't thinking about how their behavior should reflect the social cost of carbon, but their own particular investment strategies. And in that respect, of course, the shift in R-star, the shift in the discount rates is going to be relevant. For macroprudential concerns, so that's kind of the individual firm basis. Again, for macroprudential concerns, there the worry is that there may be a rapid one concern is there may be overvaluation and perhaps rapid shifts in people's perceptions of the damages from climate change, repricing of assets, stranded assets. Those concerns are usually done. Interest rates would be relevant, but it doesn't get filtered so much through the social cost of carbon, but directly to their own evaluations of the issues.
Thank you very much. So we are approaching the end of this webinar. Let me just remind you that there is a forum where you can share your information and question or that you can access through the eAxis web page. And I encourage you to have a lively discussion there. Let me finish by telling you that the next webinar is on October 12th. And it's a presentation by Joshua and Ryan Collins from the University College of London, who is presenting a precautionary approach, which I think is also relevant here because it's basically saying that with all the uncertainty about all the metrics that we have, including R-star, for example, when setting policies, we should kind of add a buffer to a precautionary buffer to the different metrics that we are using. So I encourage you to join. That being said, thank you a lot, Glenn, for this very interesting presentation. Thank you also, Michael, for answering the question while the presentation and after. And I wish you all a very good day today. Thank you very much.
Thank you, Pierre.